As we head into the last week of the trading year, we'll examine the question, is the fourth time a breakout charm for stocks? To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. The last and holiday-shortened week of the trading year may turn out to be a very important one for the stock market. This is the S&P 500 daily. Resistance, resistance, resistance. We're testing it again. Stock market relative to the fear index weekly. Resistance, rejected, resistance, rejected, resistance, rejected. We're trying to move back up to the blue line. And the NYSE Composite weekly has been a very confused mess for the most part. Came up here, resistance, rejected. Tried the same area again the second time, rejected in October. Came up off of that low before the Fed meeting, rejected in the same area, had a pullback. Now we're testing the same line again. These are what are known as potentially inverse head and shoulders patterns, where you have a left shoulder, a spike in fear here, then a larger spike in fear in October, and then a more shallow spike in fear that occurred heading into the last Fed meeting. This is your left shoulder, this is your head, this is your right shoulder. The resistance area is known as the neckline. If this continues to act as resistance, the stock bulls may be disappointed. If we can break above the neckline, then we could get a very, very big move in this direction. For the most part, it's been obvious that the bulls have regained the momentum after the recent Fed meeting. Here we're looking at weekly charts. This is the stock market risk on relative to an aggregate basket of bonds, or the AGG ETF. This is what risk off looks like in 2008, where price here is below both of the moving averages. Blue is below red and the slopes are down. This is what risk on looks like. This is the bottoming process when the stock market bottomed in 2009. You can see the stock market has regained a full bore bullish look relative to the bond market. The but that's coming, though, is we still have resistance to deal with potentially in the form of the neckline in the inverse head and shoulders patterns that we're seeing on many charts. Heading into the last trading week of the year, this tells us that the bulls do have the momentum, but they had it here, and they had it here, and they had it here, and were unable to break the neckline. So it's a prove it to me market. We'll see what happens next week. We'll keep an open and flexible mind. If we can get above this neckline, we could get a big move in this direction. Another chart that tells us the last week of the trading year is important is the long-term NYSE broad composite chart. This is the NYSE Composite Stock Index monthly. This is resistance here. In 2007, before the financial crisis, we came up and bumped up against it here on the monthly chart and then broke out. We've had a couple of retests here where these tails came back down below this level. But the recent rally and tail here tells us that the stock market does seem to care about this level that relates all the way back to 2007. Since we're nearing the end of the month, it would be relevant if we closed above this line here at 10,387 on the NYSE Composite after what appears to be right now a successful retest. Using our same weekly concepts here, this is what the S&P 500 risk off looked like in 2008 on a weekly basis. This is what risk on looks like here in 2009. This is our recent scare that we had heading into the Fed meeting, and you can see we have reestablished a full bore bullish look, we also made a new weekly closing high. So the odds do seem to be in the bull's favor relative to these necklines. But again, the stock market needs to prove it in the next few weeks. From a momentum and probability perspective, in terms of will we potentially break above that potential resistance, tech stocks seem to be leaning towards the chances are pretty good. We made a new weekly closing high last week on the NASDAQ. This is what risk off looks like. This is what risk on looks like in 2003. This is 2002 here. We have regained what we refer to as a full bore bullish look as of the close on Friday, December 26th, 2014. The Dow also seems to side with tech stocks from a probability perspective, telling us to keep an open mind about that neckline breaking to the upside. This is what the Dow looked like risk off in 1987 on a weekly basis. This is 1998. This is more of a risk on or bullish look. In 2014, we've had a very confused, somewhat trendless market, with the market basically making no progress over a 6-month period here. That's the bad news. This is frustrating and has a whipsaw type look to it from a trend following perspective. The good news is we did recently break above this consolidation pattern here, and it appears as if the recent Fed scare enabled us to successfully retest this breakout. Bullish breakout from the box. Appears that we have a retest here, and we went on to make a new weekly high. We'll keep an open mind heading into next week. Would love to see, from a bullish perspective, all of those necklines taken out in this direction. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shivako Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.